The thesis was that this market will hold 7900 to 8050 band, and a lot of smart money was selling options, both the calls and the puts. This break of 7900, now is this temporary or is this the real break? If this is the real break and the market slips below 7850, in that case I think you're looking at further trouble. But if that does not happen and the market sees a bit of buying at these levels, then maybe the Nifty can go back above 7900. But what happens in expiry week is that the problem for this market is that when stop losses get triggered, then the technical factors take over, and that's the risk for this market, that if now 7850 breaks, in that case a sudden slide towards 7800 is not also ruled out.
Okay, so we're weighed down by global pressures. By the way, the CAC is now down over 2%, and all the peripheral markets, along with the DAX and the FTSE, of course, are showing you similar cuts. And Dow futures also needs to come up on your screen. It's currently down close to about 150 points, lower on the Dow futures. So, Anuj, we're weighed down by global factors as well as expiry-related technical factors.
Yes, I think because even for global market, the call was that there are not too many triggers for the market now, either on the upside or on the downside.
But tomorrow we've got the Chinese PMI data.
Yes, and I think the fall in Germany in particular is bothering the market. In Europe is actually bothering the market quite a bit. China has been relatively stable. For last 2 days, there's not been too much weakness in China. I think that the sharp downtake is coming from Western market, more specifically from Germany. Rima, you'll remember on Friday as well, the market looked set for a big gain. The Sensex was up 500 points at one point, but then we saw post-Europe opening, we saw a big decline in the market. And that's where the risk is right now. 2 days back you had 300-point fall on the Dow Jones. The future is indicating that the start at least would be 150 point down, and that's a big risk. If tomorrow morning you have to wake up to Dow down about 200, 300 points, in that case the future itself is down about 200 points. So sometimes you have to prepare for next day's opening. In fact, this is now looking quite ugly now for the market.
Look at the ferocity of the fall. It's 7850 is gone in 10 minutes. I think we've lost 50 points on the Nifty.
Which is what the technical factor is in expiry week. Once you have a particular support mark broken for the market, in this case 7900 was the support mark. Once that breaks, it's about a lot of selling which takes place because of stop losses getting triggered, because of your technical factors. Let's pull out some of the stocks intraday and see what's happening. For example, some of the Nifty stocks. I think the key ones to watch would be the banking stocks, HDFC Bank, even HDFC. Some of these stocks, if you see the intraday chart of some of these stocks, that will tell you the picture. Pull out the intraday chart of Infosys and TCS. In fact, some of these stocks are now seeing big decline. Look at that. HDFC Bank, there's big fall. HDFC, there's a big fall. Larsen and Toubro, I would assume you'll have a similar fall in Larsen and Toubro as well. I'll assume a similar fall in Infosys. Infosys was holding 2% gains. It's now flattened out. Larsen and Toubro. This smacks of a bit of a basket sell as well, in Nifty stocks. Whatever it is, it's told you one thing for certain, that 7900 mark is now gone, and the thesis of this market holding 7900 to 8000 as a band, that's now gone out of the way. It's now how much lower can the market go from here? Will it hold 7800 or will it go even lower? One downtake was always left in the market. This was a market which was clearly giving you a sign that it had not bottomed out. But I'm surprised that it's come so early. I was expecting it in October series, but truly surprised that it's come on Tuesday.
Well, if you look at the 8000 put, Anuj, that one, in fact, to a certain sense, does foretell the story of today's fall as well. Because in the morning when the market was up, that put lost about 35% in its price. In fact, the open interest on that was close to 10 lakh. And now the market's down, there is massive short covering seen out there. The put has gained about 130% from the bottom, and the people who did write it are not holding on to their shorts.
I tell you, something to watch out for would be 7800 put, because 7800 put, it's now, the premium is up nearly 400%, Mangalam. It had gone to almost 10 rupees. It's almost, the entire premium was eaten at 7800 put, and now that's back to 60 rupees. So that's telling you that clearly there's a bit of panic in the market. I keep repeating, this has got a lot to do with technicals of the market. So 7800 really is the last support mark for the market. If 7800 does not hold, then you're looking at a really ugly screen. Even now it's a bit ugly, but if 7800 breaks, it would be really ugly.
Yes, the ferocity of the fall has scared all of us over here. But let's get in a global voice. Robert Parker, the head of Strategic Advisory Group at Credit Suisse Asset Management UK, joins us on the phone line from London. Hi Robert, it's a scary fall across the European markets. What are you picking up?
Well, I think the first point to make is that if you look at the pattern in European markets, it's still very divergent. So, for example, if you look at year-to-date figures, the Italian market is still up close to 13%, but, the UK market year-to-date is down 8%. So I think the first theme is this continued divergence between European markets. The worst performing market today in Europe, actually to start off with, is the Spanish market. Now, coming back to your question, why are we falling particularly today? I think there is still ongoing confusion in the market about what the Fed has done. And if we looked at various statements yesterday, we've now had 4 statements from Fed governors saying they are highly confident that U.S. interest rates will rise by the end of the year. And I think the action that was taken, or the non-action that was taken by the Fed last week, I think genuinely actually has confused market participants who are thinking, does the Fed know something we don't know? Is the global economy weaker than we expect? So I think that's concern number one. Concern number two is, we've now got uncertainty about the pattern of U.S. interest rates. So I think this lack of guidance from the Fed is inevitably led to some short-term market volatility.
Okay. How would a part, this uncertainty about, what the Fed is going to do, the pattern of the rate hikes from here on, has been there since Thursday. We got the outcome of the FOMC on Thursday night. Do you think this uncertainty will drag the global markets a lot lower and for a longer period of time till we actually get the next, perhaps, rate hike?
I think the answer to that is no. I think this is very much short-term volatility. And I am assuming that over probably the next 2 weeks, that market's settled down. And I think one fundamental point to make is that, number one, valuations, which back in April and May for most of the developed markets, most notably Europe, were expensive. Now we are very much in fair value territory. I wouldn't say we're cheap, but certainly that overvalued market 2 or 3 months ago was obviously now corrected. So valuations are more attractive. I think also we're coming up to, starting really over the next 2 to 3 weeks, the corporate earnings season. And I think what will drive markets will be number one, corporate earnings for the third quarter. Number two, I think better than expected data coming out of China. So, and that's against a background where the data actually coming out of Europe is reasonably good. So that uptrend in Europe, I think, also should start to ease market concerns. So I don't see this market negative move today as the start of a longer term, let's say 3 months plus bear market.
Okay, by the way, the market has taken support at 78.50, or is at least trying to take support at 78.50. Robert, final question then. What's your call on emerging market and also on a market like India? We've become, we're now ransomed to sort of global cues. But at current levels, do you think Indian market offers a good risk-reward ratio, or would you avoid emerging markets, including India?
I think, obviously, the news flow out of certain emerging markets, like the commodity-linked emerging markets like Brazil, Indonesia, Malaysia, and Russia, the economic news and the corporate earnings news remains dire. Having said that, in the case of Brazil, I would actually argue that we're close to a point where all the bad news is now largely discounted in the market. Now, India obviously is very different because India is one of the big beneficiaries from this fall in energy prices, and one just needs to highlight that, today energy prices are declining again with WTI below $46 per barrel. So I don't see the economic news flow out of India as being negative. Having said that, you're not immune from all other emerging markets. I think we're now in a situation, however, whereby emerging markets which are under-owned by global investors, which have underperformed very badly, will start to form a base, and India will outperform other emerging markets because it is a huge beneficiary from lower commodity prices.
All right, Robert, thanks a lot for your time today. So that's the global call, but As we've been telling you, this fall looks more technical in nature. The cash market volumes is higher than yesterday, but still not very high, 12,000 crore. Look at the F&O volume, 3.2 lakh crores done already, and 70% of that is out of Nifty options. Jay Bala also joins in now on the technicals. Jay, what's happening? I mean, are you surprised by the ferocity of fall, not just in India, but globally? And for Nifty in particular, what's the next move?
No, not surprised at all. Anuj, when you spoke last time, I was saying we need to assess the character of the bounce the market was doing from 7540. I was saying the market has to print 8093 to indicate that the bottom is in. And I wanted it to print before the 18th of September. So that hasn't happened. So the market is basically telling us that there's one final low that's pending for the correction to complete, for the correction that started from 9119. So that final low will be somewhere around 7480 on the Nifty or thereabouts, give or take 20-30 points on either side. So the market has probably started its final descent of this correction, and once this new low is complete, I think the right look for the Nifty for the correction from 9119 will be complete.
So that's about a 350 point plus decline in the Nifty if it has to head towards the 7480 mark. Jay, which stocks would you trade on the downside at current levels? Any trading strategies?
Yeah, it's better to look at underperforming stocks, and if you look at something like like a Bharat Forge or something from the real estate space, you could have opportunities out there. But you can even wait this out. You don't have to trade every move. I think it's rather a bit difficult to switch from the long side to the short side and the short side to the long side. So if your outlook is bullish for the longer term, you can sit out this last leg of the down move and be prepared once the market breaks 7,500. Can start and be ready to pick the low-hanging fruits.
Jay, this 7450 or 7500, the mark that you spoke, is not much lower from the recent bottom that we had. What is the risk that the market does not make a double bottom or a triple bottom and actually seeks much lower level? In that case, is there a probability, or how high is the probability of this market maybe even going to 7200, which is something that yesterday Akash Prakash spoke about as the possible downside? Is there a high probability of the market breaking the previous low and going to 7200?
Yeah, I am of a belief that the previous low is likely to break, but the probability that it will break much below that is very less likely. But you can't eliminate all the probabilities in the market. We just have to see what the market does. Basically, how we look at the market is we need the market to do a certain set of necessary and sufficient conditions, and once those are satisfied, you pull the trigger. You just have no way of eliminating this is not going to happen and that's not going to happen. We just assign higher probability and take the that path.
Okay. By the way, the minor recovery is getting sold into, so not at the low point yet, but 78.43 is what we have on the index. And pull out Bank Nifty, that's down 2% now. And the India VIX, which had gone to 80 near complacency levels, has seen almost a 10% jump. Jay, stay on with us. We need to discuss some F&O setup as well. Bhavin Desai also joins in. Bhavin, what's happening? Is it expiry-led or is it purely global in nature?
Could be, but somewhere the indications were there in yesterday's trading activity, Anuj. So if one looks at yesterday's, at least the activity in the index options front, one could have clearly seen that there was a lot of long volatility trades which were taking place, and so the long side of options was getting more emphasis, and one would be surprised to expect something like this in such an environment where a large event has gone by and there's nothing left in the offing in terms of a large event. A, B, you have a big weekend coming in, so generally this is an unusual activity which was seen yesterday and seems to have materialized already. And what seems to have caused it, probably more than expected optimism might have been created over the last few days, especially in some of the sectors like banking, where there was an unwinding pressure expected. A, B, the volatility could take its toll, especially in the week of expiry, where the should I quit or should I carry forward question once again arises. So these all things seem to have mixed up and have materialized into a move like this.
All right, Bhavin, in that case, then what are the cues that you're looking at which are stacked up as of now? Because we are seeing a formidable amount of build-up on the put side at 7,800 and 7,700 levels as well. So what do you think could be the bottom as far as this expiry is concerned, or what is your call on this expiry then?
We were not taking a call below 7,800, but as we went into the expiry on Monday, it was looking like a broader range than usual. Generally, you contemplate a range of about 150, 200 points while getting into the expiry. Of course, now an 8,000 point index, it has, in percentage terms, should have a wider range, so to speak. But 7,800 was something that we were looking at on the lower side, and keeping our fingers crossed to see not seeing a level below that. So let's just see to what extent this fall pierces, but expect at least a halt, if not a reversal from 7,800.
Okay, we are now almost back to the low point, and the selling pressure is now accentuating in stocks like HDFC. Always a stock to watch at times of expiry. Pull out the intraday chart of HDFC and Reliance as well now, and see those charts. HDFC now easily at low point of the day, 42 point lower. Let's also pull out Reliance. That's also down 3.7%. Effortlessly broken 850, so not looking good at all. In fact, would be prudent to also pull out the contribution chart and see which stocks have led the decline. It's secular in nature. It looks like a bit of basket sell in nature. It looks like there would be at least 3 or 4 stocks dragging the Nifty by at least 15 to 20 points. So that's something that we'll figure out in a bit. Jay, some of these heavyweights, okay, there's the contribution plate. HDFC 19 points, Reliance 15 points, L&T 12 points, the usual suspects. Any of these stocks, Jay, where you've seen expiry-related pressure, which you think could bottom out sooner than the market, where you could do bottom fishing, or would you avoid that?
No, 74.80 from here is a bit of a distance. I would wait for the market to, come closer to that before I take that call. But I think, the Bank Nifty has done a better job than Nifty for the move from 7540 to 8053. I think you should be looking at that sector, but wait for the market to come closer to 7,500 before you take that call.
Okay. By the way, yes, Anuj, we're again at the low point of the day, 78.20. So we saw a very minor pullback, which took the Nifty to levels of 78.50. But from there, once again, we've retreated, and the Bank Nifty is now down close to about 2.5%. And just 3 Nifty stocks are holding up in the green, and that too by a whisker: M&M, Infosys, and Wipro. Other than that, all the 47 stocks are in the red.
Yeah, and I tell you something, the market is now at almost the low point of the day. If 7,800 breaks, that's a big if, because 7,800 is a massive support, the kind of option positions that we have. If 7,800 breaks, the 40-50 points on Nifty can come effortlessly. Again, it's expiry week, and sometimes, from option seller point of view, because the loss is unlimited, you have to cover in panic, even if you believe that the market will bounce back at some point. But then when you see the mark-to-market on the screen, you have to cover your position. So 7,800 would be the most sacrosanct number, at least for today's trade, Rima.
Okay, do we have Nimesh with us for a quick check on what's happening across the dealing rooms? Okay, yes, we do. Nimesh, how sour is the mood?
Well, clearly, I guess this fall is largely global in nature. Once the Europe markets opened, we saw a sharp sell-off. A whole host of rumors are doing the rounds, right from a basket selling by a very large global hedge fund to US markets, or maybe US authorities probing one of the leading Asian markets for a particular scandal. So whole host of rumors are doing the rounds and attributed to this fall. But clearly it looks like it's a futures-led sell-off. The cash volumes are relatively on the lower side, and as I said, a lot of rumors about some basket selling as well in the futures market by a very large hedge fund. So clearly, the markets are vulnerable at this point in time. We are in this global mist of uncertainty, so that's going to continue. And what's happening is the high beta is taking the chin. Those banks, real estate, those are the sectors which are really running in the last few days, and that's actually seeing a sign of reversal in today's trade. So clearly, given that we have an expiry as well this Thursday, the volatility is going to be on the higher side. And I've been saying this for the last few days that the feedback from the dealing desk was, while we saw that a bit of a pullback rally, it was expected that this rally will get sold into. So it's happened into this trade. Still, there is no conviction cash buying happening. Even in the cash market, the F5 numbers that you see for the last few days, it's largely because of some of the block deals or for the FTSE rebalance. So if you exclude that, the FIs have been still net cash sellers in the cash market. As I said, today is a reversal of all the high beta names. So the bank stocks, real estate stocks, all have taken for a beating. It looks like from here on, the expiry will be very critical to watch out for. And there is a lot of hope built up into the bank stocks with regards to the RBI policy. If that is not met, probably you'll see more pain in the bank stocks and in the bank nifty. In today's trade, the feedback is this is purely global in nature, and the sell-off is largely led by future selling, not much in the cash market.
All right, Nimesh, thanks a lot for that. The Nifty has managed to defend 7,800. It does look like, for now at least, that level has been defended. As you can see, from 7,850 and thereabouts, it's been a 20-point jump that we have seen on the Nifty. But really, it's been that kind of a day where you don't know for how long that's going to hold. Amrish Palika is also with us, and we have Jai, Bala and Bhavin still with us. Amrish, good afternoon. Has this surprised you? Because it looked like a bit of near-term bottom was in place.
Yeah, in fact, it was a bit of a surprise because I was expecting the markets to just hold on in a band for the day, looking at the way the markets are behaving in the morning. But yes, this is clearly global in nature. Once Europe opened and once you've seen that Dow futures also down, that the market has corrected very sharply out here. But still, I think we are still in a safe zone. And as long as we don't break that 7750, 7800 levels, which doesn't seem to be, I think it's still an opportunity to buy. And especially those who had missed out in the last few days, I think it's a great opportunity for them to buy. And at the same time, those who are short, I think it's an opportunity for them to cover. Because looking at the way the RBI monetary policy should pan out, there's no reason as to why the markets should crack further from here. So I clearly see it as an opportunity.
Okay, yes, we are hostage to global factors. But Ambarish, coming to that RBI policy later this month, it seems like a 25 basis points rate cut has been completely priced in. If it does come through, do you think the markets will just ignore and continue to focus on global cues?
No, I don't think the markets will completely ignore that. If 25 basis points does not come, yes, then I think it's a major negative. But if we have a 25 basis points cut, there could be a small, uptick. But it's very much possible that we could also have a surprise 50 basis points. And if that happens, I think you should see the market at 8,050, 8,100 levels. So the way I see it is, it should be in this range of 7,800 to 8,100. That's the broad range I'm talking about.
Okay, Bhavin, in terms of option strategies, we've seen a big jump in India VIX today. Any option strategy that you would like to suggest?
Very juicy options, Anuj, on the lower side. Of course, we've been running with a decent skew. The put IVs have been fairly higher this time around than the call IVs. So, probably a hedge can be deployed at least at this juncture. In case if 7,000 is taken off, chances are that it might open up a 300 points kind of room on the downside. So probably, especially in the October series, one can get inside where there's still premium on the lower strike. So a 7,800 put can be bought to fund that. A couple of lots of 7,500 put can be sold and protected by buying a 7,200 put. It's a butterfly strategy, slow money, but very inexpensive and makes a lot of sense in case if the in case of this juncture where the walls are very high.
Ambarish, we know one of the reasons for today's fall is to do with the weakness across the global equity markets. Anything else that you've heard which could have explained this kind of a sudden fall?
No, there is no other reason for this sudden fall except for the global markets, because I was not heard of any other events which could have led to this fall.
Okay. Jay, from current series point of view or next series point of view, is today also a good day to take short position, or would you wait for the market to give a 50-60 point bounce before taking a short call? Because today's decline has already been almost 2%. So would there be temptation to hold on today and maybe take short positions only on a bounce, or even right now is a good time to take a fresh shot?
It might be a good time to short now, Anuj. But but if you get a 50-60 point, that's the ideal scenario. But it's not a guarantee that you're going to get there. But that is the ideal scenario. But I think this could be a decline straight off from here. So there's no guarantee we're going to get that one more pullback to 7,900. But if it does, you must take that with two hands.
Jay, a word on how the markets are likely to react. Would there be, if there would be a rate cut from the RBI, a 25 basis points rate cut, as they say, has been factored in. The Bank Nifty has been outperforming, perhaps playing for that rate cut. Do you think that would be a trigger for the markets to turn around, or that would just be a minor dead cat bounce?
We don't look at markets from that point, and if recent history is any guide, we had rate cut on the day or just around the market hit 9119. We've seen that the markets have more or less fallen around the days of rate cut rather than rising as people have been anticipating. So we look at markets just from the price structure. And markets have their own endogenous events that trigger. They don't look for exogenous events to pull and push the market. So we are agnostic to whatever happens from the point of rate cuts and interest rates and things like that.
Okay, the minor recovery, and I use the word minor because it in the context of fall it's minor, is led by ITC. Pull out the intraday chart of ITC, that's now in the green.